Good afternoon, Quasar Markets Live. We have the man himself, global investment strategist, Michael Litt, in the house. How are you doing today, Michael?
Very well. Very
awesome.
well.
Awesome.
As
what do you have for us today?
Summertime and the living is easy.
It's I love it. I love it.
Podcast of the summer. So I thought I'd cover sequencing of what I think the incoming market information is, because we've gotten through this very tumultuous period of confusion. And a few things have been starting to become clear, at least in how the markets are going to receive information over the next, say, 3 to 6 months.
Okay.
And I think that will help people start to anticipate what's going on. And we can explain some of the things that have happened through this sort of discussion today. It's a little bit of an overview. It's an overview and a forward-looking thought process. So 4 things that I'm going to split this up into. The first is that the economy is weakening faster than inflation is showing up, right?
Okay.
The consensus, as you and Stephen know, is shifted from 1 25 basis point cut this year to 2. And that's why we've seen the 10-year rate drift down kind of in a very volatile manner, down from 4.5 to 4.30, right? As it has factored that in. The 2-year has come down, even the 30-year has come down. They've all sort of come down in lockstep. But inflation is not coming through, and we'll talk in large part because of the way that inflation is, the tariff inflation and the currency devaluation,
right,
which people talk about.
We've had our man Stephen Flanagan, who I think you know from his days over at JP Morgan running their Forex stuff, talking about that.
Yes, and people aren't. And Stephen's right, he's spot on right there. We're going to talk about the OBBA reconciliation process and a few things that I have done some digging, gone to the farm country and around some different states. I've talked to 1 Republican U.S. Senator, 1 Democratic U.S. Senator, and 2 Republican House members. I've gotten a feel for what it is that's driving their thought process on OBBA reconciliation.
Okay.
The downward earnings revisions you and I talked about a month ago has continued, right?
Yeah.
E is for earnings was our call, and we'll revisit that. And then we're going to talk about when upward inflation pressures will arrive. And the sequence in terms of timing is in this order: weakening economy, OBBA reconciliation, further downward earnings revisions, and then the upward inflation of pressure starts showing up in the data later, possibly as late as August, September, right?
Wow. Okay. I thought there would be a lag. I didn't think that far. Wow.
Well, we'll talk about why that is. So let's see where we are here with our economy weakening. Right. So the consumer confidence index hit the news 48 hours ago. And when I looked at parsed through the granular data, every age group and every income bracket fell. It wasn't just a fall on average. It was actually every income and every age group. So consumer confidence is now falling down. And as we had talked about way back, all the way last year, the year before, it was the consumer who was driving the bull market, the 4.5-year bull market from May of 20. And they really are backing off. So the consumer that was the spinal cord of this upward move in stocks, earnings growth, final demand, their balance sheets remain in good shape. But they're reticent to borrow and buy houses. Spring traffic was anemic. It was 30% below the average for the 3 prior years after COVID. And so they're not making big purchases. And not buying a house means you're not buying the extra. You're not moving to the suburbs, buying the extra car, buying the new washing machine, the new refrigerator, all the durable goods. So
Absolutely.
that's not happening. So we now know the consumer confidence is falling. It's falling across the board. Let's look at the next one, which is the deficits, right? So the OBBP, the deficits are increase by. I remember I didn't want to talk about this when we were talking about earnings. I said I wanted to wait for the dynamic numbers to come out. Remember that?
Yeah, I do.
The conventional is in light pink. The dark red is the dynamic. And that says, okay, you do these things and you paste them on top of the existing economy and you get the pink bar. Well, but then you say, okay, well, what's their impact on economic activity? That's dynamic. Now you get the dark red, the deeper red bar.
Yeah.
So most of the services have the deficit increasing between $3 and $3.5 trillion above what would have happened had the tax cuts, the Trump tax cuts, went, those were timed out and you went back to the prior tax regime, right?
Yeah.
Which you could call that a tax increase, or, you could call it the end of the tax cuts. The administration likes to call it, a tax increase by letting them sunset. In any case, you're adding 3 to 3.5 trillion. People talk about that as if that's the deficit. It's not. Over the 10 years, and everybody measures this on a 10-year time horizon, 223, we're adding 21 trillion so that our deficit will then be 53 trillion. Okay. And let's look at and now the tax foundation, they're somewhat conservative, and they say, well, we're not considering, for instance, that foreign trade will change because of tariffs.
Right.
Well, foreign trade is already changing. There's a whole bunch of, you might look at that. That's the looking through rose-colored glasses.
Right.
You only add 19.5 trillion and you're at 51.5 trillion.
Wow.
Okay. So that's the rose-colored glasses.
I don't like those rose-colored glasses, Michael.
The administration has its own view of this thing, which is $2.6 trillion better than any of the other estimations, right? So, and that's the Center for Economic Advice, the president's
right.
Right. But again, you can't grade your own paper. So look at the next one. So it's and let's look at this on a share of GDP. So had the tax cuts sunset, you would have actually had the deficit going from 6.25% of GDP down towards 5% of GDP, which was, that would give you a fighting chance. Now, it still climbs back to over 6% because, as we've seen in the charts I've shown before, we have the aging demographic and we have the transfer payments for Social Security, Medicare, Medicaid, right? So those on that from 27 to 34, those are still at work, right? And so now OBBBA, as written, has a whole bunch of things getting sunset at the end of the current administration's term. But if they were continued and made permanent, then you would see the red line. So you would never get below 7, and you'd start to go to 8% of GDP. So that's the trajectory. The deficits on that page, the bar chart you just
sorry, jumped on me when I was trying to do.
Yeah, that's all right.
I was trying to draw the line here at that spot where you got the top here.
Yeah, that's over 8%.
Wow, that's a big swing. 3% of GDP. I mean, we can't get NATO to spend that on all of their defense.
You're far away from Bessent's goal of 3%, right?
Yeah.
So this bill, and I was hoping there'd be a more cuts that would get us back towards the blue line,
Right.
or at least between 6 and 7% from the Senate, but it doesn't. My conversations with the senators and the House wants to push it through. We got to get this through. We got to get it through. We can't, the president needs this push through, push through, push through. They want this pushed through urgently. And we'll talk about why in a moment, but let's look at how front end loaded these in the bar chart, these deficit additions are. So we're talking about 400 to 500 billion dollars a year starting next year.
Wow.
Of additional. Now you could look at this two ways, Howard. You can say, well, the government isn't spending the money. The government is just borrowing the money to support somebody else's spending. Well, they're giving the money away through tax cuts.
That's right.
To other people to spend, but they're still spending the money. So we're borrowing more money, right? It's fiscal stimulus.
Well,
go to the next page. It through the back door of the House, and then you assume a lot of those assumptions on the yellow and red line on the prior page, right?
Yeah.
Assume that interest rates came down to 3%, right?
Yeah.
Or 3.5%. If interest rates were at their current level, the dotted line shows you where the deficit goes because of the interest costs of carrying $32 to $54 trillion of debt. So you're getting a compounding effect where and now this is over till 2054. So if you look to 2034, it's a smaller, but it still adds about, 6% to GDP. So you would be adding something like another 0.5% to 0.6% a year on average over that 10-year time horizon. So you're well above your 8%. You're getting closer to 9% debt to GDP if the cuts become permanent and interest rates were to be at current levels. So there's some critical rate assumptions in there. Again, rose-colored glasses that we're going to have these very low interest rates, or that the Fed is going to do QE3. And a little bit of what's my spidey sense is telling me is that these deficits are so big that if inflation starts to get out of hand, they're going to have to react. The new Fed chairman may be implementing QE3 before long. And I think this is what Jamie Dimon's referring to in terms of when this hits, when this all comes home to roost, you're going to panic.
Yeah, I mean, he's been saying it, right? Jamie's been all over it, that the disconnect in the bond market that no one's watching.
And the guys who are real seasoned pros in the bond market, the long duration, I mean the 10s, 20s, 30 years, they have grave concerns. And I can see the intersection of what Jamie is thinking about and these factors that we're discussing here coming home to roost through this avenue. Now, look at how much now we can just charge it to the Underhills. That's the old.
That's right. Steak sandwiches all around.
Chevy Chase's line from.
I love it.
From that movie.
Caddyshack. No, Fletch. My favorite. One of my favorite movies of all time.
Charge it to the Underhills. Our net interest costs, and this is at the 3.5%. This is at the 3.5%. This isn't at the current rates, right? This is at 100 to 150 basis points lower than we are at right now on the long end. $1.8 trillion of net interest costs. So our interest costs double over the next 10 years. That becomes a rock that you can't really move in our in a way. How do you pay that back? What the Germans did in the 1920s, eventually late 1920s, they said they just devalued Reichsmark.
Yeah, the currency. Yeah.
Just devalued it, and we're paying you back in worthless paper. Well, if anything argues that you're going to have a secular move in the dollar downward, it's this, right? And that just paying back in less valuable currency. It makes an argument for Bitcoin. It makes an argument for gold and other hard assets.
Yeah.
Makes an argument for infrastructure investing. Makes an argument for investing much larger strategic asset allocations over the next decade that have much larger non-US dollar exposures. And if there's anything portfolio allocations are lacking, and my friend Scott Slayton made this point in a really interesting discussion the other day, they're really underallocated to non-dollar assets. And that would be the lurch. Like, you're always looking for where people are, money's going to go.
Right. Yeah.
Realizes what the game that the markets are playing is. And that is where the money would flow. And we've talked about that since the beginning of the year. It's, the German government bonds and dollars and euros are now up. I mean, it had a 2.9% yield, but the thing is already up, almost 18% on the year,
Oh, yeah. The days of king dollar for me seem to be at least waning, if not gone.
It's a secular. It doesn't mean the dollar's going to go down every week, every year, every quarter. It just means that if you're going to have to pay back that much interest, then at least the solution with the Reichsmark 100 years ago was to turn it into worthless paper, and it argues for a lot of other alternative assets, right?
Yeah, no, absolutely. I mean, and it's what France did to Africa for 100 years too, right? Devalued their currencies so that all those raw goods were all cheap.
Yeah. In fact, that's why Haiti is the mess it is today, because of that policy.
Yeah.
So it has repercussions. So interest cost is a real issue. Let's go further into OBP. 199A. This is the part of the tax budget bill that everybody loves to hate, except for the people who are donors. And this is what nobody likes this. There's no economist that tells you this is a good thing. They've increased the pass-through deduction to 23%. It's going to cost $809 billion over that 10-year period. And look how it's distributed amongst household incomes.
Yeah.
They call it the car dealer exemption because there were a lot of those people in that business who donated, and it's a huge boon to them. It's a huge boon to a number of service practices like lawyers. Believe it or not, the litigation lawyers that you see on
TV
billboards on the highway, they're a big beneficiary of this. There's no economist that argues that it helps the economy. And it was part of the 2017 Trump tax reduction. And it has shown 2016, 2017, it has shown no trickle down effect or no impact to workers or workers' wages or employment. So this is a really expensive one. So the question is that I'm answering here is, where are we spending the money? So interest cost and 199A, which appears to be a political, there's a lot of worry. All of the senators and congressmen I talked to are very worried about pushing OBBPA. To a representative, they hate the tariffs. They will tell you off the record, I do not like the tariffs. But they want to push this bill through because they've got to keep their donating constituency together through the midterm elections.
Yeah.
A lot of that thought process I was hearing sort of the sort of what I was hearing in the echo of those conversations was that they are worried about the election process in midterms. They need to do favors. They need to get this pushed through. They're okay putting us on that massive deficit trajectory to save their bacon in the midterm election. It may be one of another. It's not a great trade.
Yeah,
but
no,
it
definitely.
seems that that's the subconscious thought process that I observed. Let's see
And
what
I've seen that in DC and talking to him also. It's about self-preservation more than it is about what's correct.
that. Well, it clearly, I mean, they've tried to convince themselves that the White House's version of the $2.6 trillion variance from everybody else's analysis is correct. I mean, there's some Kool-Aid, and you need
To say the least.
But this is not our finest hour as a country in terms of a tax policy right here.
Yeah.
And I'm not even not just the demographic distribution of it, but it's not like we're giving a deduction to manufacturers or job creators. You know what I mean? It's not.
Yeah, if you're spending on infrastructure, if you're giving it to something that's actually to bring real jobs in, then that's one thing. If it's being done so that your donations stay at the level you need them to be reelected, probably not the right idea. Yeah, and when the fundamental doesn't make sense, the excuse for doing it doesn't work.
And again, it's almost impossible to find any economist who thinks this is a good element of the OBBPA. Okay, let's see what we got next. So I looked, there was some stuff I noticed. There were two things I noticed. One was the farm component of it. And there was a big number in there. There was a big cut. And I thought, that's interesting. Well, what they're doing is they're cutting supplemental nutrition assistant program. When you can imagine where the supplemental nutrition assistant programs it goes to the lowest income houses.
Yeah.
So they're cutting that. And then there's a farm subsidy increase of $57 billion. You thought, oh, that's a good thing. Well, I went to Iowa because Iowa, I forget their farmer. Let's see what they're saying about this. I looked in Nebraska too, but I found this Iowa Capital Dispatch, which is the Des Moines paper. And there were two interesting comments on these two numbers. First was the slashing of SNAP is just to distract from what is a raiding the treasury for politically favored crops, peanuts, cotton, and rice, which happened to be grown in the South. Yep. So it was a handout to large Southern farmers. And they used to be that the farm subsidies went to farms that were smaller. Yeah, they removed the cap.
Yeah.
So what's happening is all of this money, or most of this money, and these Iowa people were pretty brutally honest in this article, is going to these big, gigantic peanut, cotton, and rice farmers.
Yep.
Who essentially we're going to be subsidizing profitable businesses.
Yeah. No, I live in Ohio in the middle of farm country, and subsidies are all that's talked about here. And it is, it's the hot button topic. And you are right. It is a political hot button.
It's not, again. And then I dug down further down in the article. A guy said the farm subsidies go into effect immediately. The SNAP and the nutrition provision usually have longer implementation dates, and they get changed before the cuts are implemented, which means, right. So the cuts probably won't happen anywhere near that magnitude. They'll save, the poor people will get saved. The big farmers with subsidies will get money from the treasury. And guess what happens to those deficit trajectories we saw earlier, Howard?
They continue to go up, and the middle class is the ones that get hit from both sides.
So so the slope of those curves is straight up. The other one I saw, and I didn't put it in here, and I meant to, but staying on that page is the Medicaid that the states implement for, again, the poorest people, right? The government is saying we're cutting that spending and shoving it to the states. Well, the states were the ones who had managing the lower cost Medicaid, old age facilities, the drugs, everything. And so it didn't get cut. It actually just got pushed onto the states.
Right.
So the states are going to have to cut some other spending or raise taxes to pay for it. So what's going to happen is the spending doesn't go away. There'll be some pressure to pay less for it. Maybe the states can cut 10, 15, 20%. I don't know. But, and the administration would say, look, we're trying to root out fraud. If the states are giving people money that's fraudulent, they're going to have their eyes peeled a little sharper. Okay. But the taxpayer is still going to have to pay for it. They're just going to have to pay a state tax now.
Right.
And so there's a very large amount. It was hard to get the numbers, but it's in the, $400 billion range that's getting shoved over the 10 years. It's getting pushed on the states. That looks like a savings, which really isn't a savings. It's just going to come at the taxpayer.
Yeah, it's going to be a different spot on your paycheck where they take that from. So
there's, all these numbers and all the calculations. When you dig down and start doing some work, you find out that there's a little bit of,
so maybe all those savings aren't really there.
They may not all be there, or they may not all be there for the full term of these projected 10 years. So let's see, what were we going to cover in the earnings. So now we're down to a 7.5% year over year growth. I can't remember where we were with E for earnings. It was higher, right? It had come down from 13% in December. So now we're down to 7.5.
7.5, 8% in that range.
It was 8 or 8.5, and now it's come down another percent for year over forward. So this is 12-month forward looking earnings growth. And Zach's pointed out that there are lower earnings growth for 13 of 16 sectors. Consumer discretionary, interestingly, has been
that's a surprise to me. That is a very big surprise based upon what we've just seen about consumer sentiment. Shouldn't that be going down?
It may have gotten cut earlier. I don't know, but this is over the last since the beginning of the quarter. Not surprisingly, aerospace.
Right.
Holding up very well. More defense spending. We're in a world where you've got regional competition. Europe is on its own for its defense spending. The U.S. defense spending budget has increased. It did not get cut. And China is, spending on aerospace. There are some conflicts which are causing a spending. So aerospace, and then utilities. Utilities have gone up. The other sector that I've been seeing earnings, it's a subsegment of financials, but insurance. Insurance company pricing has been extremely strong, raising rates on everything from wind to car to boat.
I've seen it myself. Everything, they're all getting hit for sure.
Yeah, and they've got higher yields in their portfolio. We always talked about their net margins, their loss to their income, and their portfolio yields as those bonds from the ZIRP era are maturing, are being reinvested at much higher rates. So the average portfolio yield for the insurance is climbing while their pricing is climbing. Their margins are expanding rapidly. That sector is also doing very well. But in general, we're also seeing, as the market approaches, the S&P approaches its earlier in the year high, right? We're seing a very narrow. Not only we're seeing low volumes too, right, Howard? You have your
volume. It's amazing to me today that we could break to an all-time high in the Qs on very low volume. It's crazy,
and it's narrow. The breadth is extremely narrow,
very limited. Yeah,
and the again, we're right at the highs, and we'll see later where the euro is, but the Euro Stock 600 is now 24% ahead of the S&P.
Yeah, no, I've been watching it. You brought it to us 6 months ago, so I've been keeping an eye on it.
And we're staying with that. We said, and I said in my last call with Steve, it's going to lap the S&P again.
Yeah. Wow. Okay, that's a big call.
We have it. This is just percolating here, right? It's percolating. Yeah. We've got the consumer. The consumer is final demand. my spidey sense is telling me that next time you and I look at this chart, it's going to be sort of somewhere between 5 and 6%
Wow.
forward growth, for which you're paying an all-time high.
Yeah.
Right. So you must be banking on interest rates going lower.
But how low are they going to go?
Well, here's the problem. This is the question that Powell has been asking, which is in this inflation that we're going to see from tariffs, permanent or transitory. But the tariffs are not operating in isolation, right? The first thing I will tell you is the reason that it's the last thing on my list is because it appears to be hitting business input costs first.
Right.
It's not getting to the end buyer or consumer as quickly as people had anticipated, in part because of that big inventory build in Q1, which wasn't, remember when they revised GDP, yesterday, and now it's down. We shrank 0.5% in Q1, right?
Yeah. The
inventory build was a little smaller, but the consumer pulled back, and it was the consumer pulling back that really lowered GDP. What's interesting to me is the consumer was already starting to pull back in Q1.
Right.
Right.
Yeah.
But the cost increases have not gotten to the consumer as quickly as we might have thought. Now, as Powell said, we've never dealt with anything like this in our lifetimes. Right. And now toy prices, I noticed one component, when you go into the subcomponents, toy prices increased 2.2% in 1 month. So whatever that is annualized, 30% annualized increase, right? So Tom Tillis is a really, really great senator from North Carolina. He is not one of the senators I spoke with, but companies have a lot of experts and this is what he said when Powell was getting really pilloried in his report, the congressional report. They're suggesting there are inflationary risks. We haven't realized it yet, but I think we all need to keep our eyes open. And I think Tillis is actually a really, really pragmatic and thoughtful guy. And it's interesting how he voiced that to Powell, saying, "Hey, I'm here, and I hear you on being concerned about inflation." Tillis is powerful enough within the Senate to be able to say that, which they were saying, as I said, the 2 U.S. senators and 2 congressmen I spoke with, they both said they didn't like the tariffs and they were worried about its impact.
Well, it's never worked. I mean, tariffs have never worked. I mean, that's a proven fact. Again, sort of goes like you said, with every economist saying that the pass-through for deductions is a bad idea. 99% of economists outside of Scott Bessent say that, tariffs are bad.
Well, and let's go back to, I still maintain that we needed to be tough on trade. China is an unfair. I've given my whole explanation of a neo-mercantilist state and how they cannot coexist with free trade and globalization. Right. So it did need to be dealt with in defense of the administration. Were the manner in which the tariffs put in place to generate revenue to justify OBBBA.
Right.
Okay. Again, you kind of, I'm not sure. What did you do? You just put the tariffs in place to pay for the pass-throughs. Yeah. Wow.
Okay. Yeah, it doesn't hold water, so to speak.
Well, you certainly have to sort of ask a few questions, right?
Right. So and my statement there, not to get off topic, is that again, I'm with you on China, but was Mexico that bad? I mean, I guess fentanyl or whatever you want to say, but there are other countries we hit that have been good trading partners of ours.
Well, we use the fentanyl and the immigration thing, and those are certainly, immigration was not dealt with appropriately in the last administration. And again, there were things when I did that call back in March. I said there are a lot of laudable objectives the administration has here.
Right.
It's the implementation of the
I was
policy.
gonna say the execution
Are
is
they
what
getting
the
us to
execution of it.
those objectives, right?
Yeah.
That's what we always have to keep asking ourselves as informed citizens who participate in our democracy. All right, what do we have next? We have, oh yeah, here we go. So this morning, the euro hit another high, right? 117. Again, I agree with the gentleman you mentioned earlier, his view here. It's clearly part of this bigger process. And when Powell and Tom Tillis sit there and ponder, are tariffs inflationary on a temporary or permanent basis? Well, this is permanent, my friend.
Yeah.
Right? This is permanent. Tariffs, a friend of mine has a business where he redoes high-end medical offices and high-end retail stores, some on Fifth Avenue. And he had to order these plate glass. He's redoing one of the iconic brands in the world's store on Fifth Avenue in New York. And he had to redo the glass with the extruded aluminum frames. And he said to me, look, I'm seeing, for the materials I'm getting, I'm seeing 10% base tariff, 25% on the aluminum component. That's 35. They're charging more for freight because a lot of people aren't picking up their freight. They're having to ship it back. Freight volumes are way down, as you've seen.
Yeah.
And so freight rates are up. So he was talking about more like 40+% total increase in materials cost. And you haven't even factored in this euro move.
Right. Oh, yeah.
Once they increase their price in dollars to adjust for that, right? And the tariff, okay? So, and remember, your portfolio of investments, if it's 98% in dollars, you have no hedge against this issue.
Right.
People need to think about hedging their portfolios by buying European stocks or
I did some of the Japanese, mega banks, that SMFG and some of the things, Mitsubishi, like that are, they're hedge funds, so to speak.
Yeah. And the reason you don't want to is because our interest rates are high, as we've discussed.
Yeah.
Our interest rates are higher. Well, why would I want to buy a German government bond at 2.9% if I can have a U.S. money market at 4.25%? Howard, you'd be a dope.
If the money goes burn in the U.S., it doesn't matter.
Your currency, your currency is depreciating. And you have to think about the Weimar Republic and the debasement of a currency in the face of unserviceable debt payments. So I don't want to be dark, because ultimately I said the deficits and the OBBBA is a giant stimulus package.
Yeah.
All those people who are getting the $809 billion are going to have more money, right? The weakening of the economy before the inflation shows up later in the year might justify the Fed cutting twice, right? So financial assets give the illusion of doing well because you're borrowing a lot more money. The thing that will send that off the rails, what would upset that narrative, would be what Jamie Diming's talking about, where the back end of the curve suddenly says, wait a second, this currency is starting to smell like three-day-old fish.
Yeah.
And you've got inflation showing up, and all of a sudden the 10-year's not at 4.30, it's at 4.75.
Nice. Oh.
And the 30-year is at 5.25, and mortgage rates are over 7, and the housing market slows further. And that's when you've got, if you think you have pressure on the Fed right now, just wait until you get to that in the winter. That's why this is called summertime and the living is easy. This is as good as Powell is ever going to get it, Howard.
Yeah, I was in such a good mood coming in here today, and you're just trying to bring me right back down over the edge again.
S&P 500's at all-time highs.
Yeah.
Let's put the rose-colored glasses on and have another glass.
Another glass of Pinot Grigio, and let's go buy some more.
Put a floater on your rum punch there, Howard.
Yeah, that's what I want to do. You're ruining my whole buzz today there, Michael, but it's true. This is what we do at Quasar Markets, though. I want to point it out is that so many places are just telling you, the lead line, S&P all-time highs. What they're not telling you is what's happening in the undersets. These are the tectonic plates that are going to decide how the market moves in the next 12 months.
Right. And this is, we're here almost at June 30th. So we've looked forward into the second half of the year. We've sequenced it. We've talked about some assets that your asset allocation ways you should think about it. Look, I don't know. There's a hope strategy is that all these tax cuts are going to cause a huge underlying economic growth, right? That's going to justify 21, 22 times earnings on the S&P right now. There is a view that everybody has it wrong, that tariffs are just a revenue that's going to and are leveling trade. People will play by the rules. China will start to move away to some degree from its neo-mercantilist economic policy, and we will see the tax cuts increase the incentives to work and the incentives to invest in the United States, of which there are some in the tax policy. They're not all like 199A. There are some good incentives there for that. And that the deficits will be much lower, $2.6 trillion lower, based on the view, the White House's own scoring of their paper. That is the narrative that would justify paying 22 times for earnings growth that is coming down into single digits and perhaps going to flat year over year, right? I mean, we're just looking at the numbers and we're trying to say, well,
yeah. I mean, I guess my question would be though on Europe is, their GDPs are even worse.
Well, the GDP revisions in Europe they're revising GDP from a lower level.
Right, from a low,
yeah. We're now looking at upward revisions in European GDP and downward. I think the average economist has GDP growth in the United States in 2025 right now. It's somewhere between 1% and 1.5%. Right?
That's an even
2% the other day.
Yeah.
And they think, and then we'll be fine. And then it's one of those, in 26, it's all going to be gangbusters, right? But it may be that we get to Q4 and we're looking at one elevated inflation report after another.
Right.
And a consumer, and there was a chart that I didn't get in here is I noticed that the consumer has started saving more. The saving rate is in the PCE deflator report, and it's jumped up from 3% to 5%. Now, savings isn't a bad thing. It's a good thing. We should save more. But when people save, they don't spend.
Yeah.
It's the other side of the coin from the consumer pulling back. And there was another report that came out this afternoon, the consumer survey, that they're pulling back and spending. But you can see it actually in savings hitting 5% in the PCE deflator report. So anyway, savings is a good thing, right?
Yeah. Yeah. It's what, Jamie Dimon pointed to. It's what.
Oh, there it is. There it is right there. You see that
saved up during COVID was the savings that we had coming out of COVID.
Correct. So what we are seeing is an increase in household savings. And as we see, the households are in great financial shape. but they are, there's concern, and they're
The truth, absolutely.
I think that the household is in such good shape financially, moderates how, if we did go into a recession or stagflation, it moderates how bad it might get. And the market may be pricing that fact in.
Right. We're not nearly as over leveraged as 2008 and as other times where we've hit these things.
No, it's a completely different animal that, frankly, we don't understand.
Yeah, that I'm with you. It's what I've seen and talking. I love to go out and talk to the everyday person about what they're thinking and what they are, and the views I'm seeing is I'm cutting back. I'm okay, but I'm worried about the future, and it's one of the first times I've seen people take that pragmatic approach. And it's quite honestly, it's a smart approach. What we're not seeing is that from the retail trader at all.
Well, again, the retail trader rode the dot-com bubble over the cliff at full speed.
Yeah.
They rode the subprime mortgage credit bubble over the cliff at full speed. Do not ever forget that. We've talked
absolutely. About it. And they did it to Bitcoin. Listen, it took years
Julian
to come
Robertson found out, trying to short dot-com stocks, you can be early, one of the greatest investors of all time, and have to cry uncle before you get.
Yeah, the famous line, right? The market can stay irrational longer than you can stay liquid. And that's true.
There are a lot of people wondering if that's the moment we are in right now. Right?
Yeah. I mean, I look at just these IPOs in the last couple of weeks. Circle. I mean, I'm a huge fan. No one's a bigger blockchain proponent than I am. It's not a $50 billion company. I'm sorry. 66 billion today.
If M&A volumes in the second quarter are going to be the lowest.
Oh, really? Going down?
No, they are.
Because we've seen the opposite over the last first quarter, right? We saw a lot of M&A for the first time.
Well, there was some M&A, but there hasn't been a lot in Q2. Exits from DPI out of private equity funds has been anemic. There was one of the large private equity firms sold equity into this rally in the market.
Right.
4 big investments they had, and I think they were happy to do so. And they were smart to do so.
Right.
Because they were able to show return of capital to their limited partners. But I think this is, the smart money wants to be a seller. If you look, Berkshire Hathaway continued to raise cash.
Yeah.
You seen that?
Oh, yeah.
Continue to raise cash. And again, it's tough to predict the timing of this. All we're doing, we've given you our folks a roadmap.
Yeah.
To anticipate the sequencing of how this is going to play out. We've talked about some of the details about the reconciliation and tax and spending bill, what's motivating congressmen and senators. Yeah. We talked about some assets that I think are going to be more attractive, sectors that are going to be more sector ETFs, non-dollar assets. I still like the emerging markets. They have fiscal. My emerging markets manager keeps making all-time highs.
Really? Okay. Makes sense. Yeah.
All-time highs. They have the ability to expand fiscal spending in those countries,
right?
Like the Germans did. We don't have room to expand fiscal spending, but we're doing it anyway. And
it shows you it is a difference. I think that the subline of this should have been King Dollar with a question mark on it.
Let's keep it all out in front of us and let's invest wisely.
Absolutely. Michael, thank you so much for joining us. Like always a pleasure to have you on. Any last words for our people?
Go out to a baseball game and have a hot dog and a beer. I'm going to do that next week.
I love it. I'm actually headed to Boston, so I'll go watch a Red Sox game without a doubt.
Good for you.
Have a great week, Michael. We'll talk to you in a few weeks. Thank you, sir.
Happy 4th of July to everybody.
Everybody also, you too.